Okay?
Go ahead.
Yep.
The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. This is Chris Sinclair. I'm the Executive Director of AXO, and welcome to our second Ask an Expert webinar series on gift accounting and budgets, bridging the gap between development and finance. I hope all 22 of you are well today, and we'll get a lot out of this, what we think is a really important topic and one that we presented at the annual conference last year. Our presenters are Kate Akosh from San Francisco. She's a well-known, well-respected woman who's had a really diverse career in arts management. She's also a pretty good violinist, fiddle player. And Michael Costa, who's been with the Philharmonic Baroque Orchestra in San Francisco for 4 years. He began as Finance and Administration Director and is now the Executive Director of this quite wonderful ensemble. So I apologize to maybe 2 or 3 of you if you heard us going a little crazy before we officially started this webinar a little earlier. I'm not sure what you heard. You know, we sit here and we talk to our computer, which is a little odd, so I can't see your faces. But I hope you will enjoy this very much. We'd like you, if you have questions, we'd like you to type them in, and then Kate or Michael or I will be monitoring them, and we'll either read them back or we'll take you off mute and let you speak. So here we go, Michael and Kate.
Great. Well, welcome everybody. I'm Kate Akosh, and I have spent much of my life working in orchestras and for other arts organizations. In California, I moved out to San Francisco to work for the San Francisco Symphony many, many years ago. And as a consultant, I have worked with the Pacific Symphony, the Long Beach Symphony, the Marin Symphony, the Sacramento Philharmonic, the Stockton Symphony, Carmel Bach Festival, Santa Cruz Symphony, in a variety of ways. I love development, I love boards, I love connecting donors with institutions, and I was very excited when this topic came up because I think it's often difficult for the two departments, development and finance, to find a way of working together, and it's so important. So we hope that you get some good information from the session, and please feel free to contact us afterwards. Again, we will take questions as we go to try to address any concerns that come up in a timely basis. You don't have to hold until the end. If we think that it's better to wait to answer your particular question until the end, we will. But please use the space to write in, and also feel free to contact us individually afterwards. And here's Michael.
Good morning, everyone. As Chris mentioned in the introduction, I've been at Philharmonic Baroque Orchestra for 4 years. I came to the orchestra world having had a first career in the world of education, both as a classroom teacher and then working in program management for an education nonprofit. And when I started with Philharmonia, it was really from this from the finance side of it. I was the director of finance and administration for my almost first 2 years that I was here before becoming executive director. So I was very happy to have the opportunity to do this presentation again with Kate, because I think we both offer a range of perspectives that hopefully will be helpful to this specific question of looking at how finance and development can work together to be as effective as possible in meeting their organization's mission, and ideally minimize the headaches that sometimes get caused. This keeps popping up here, and I apologize, but I'm going to just keep closing it as we go through. So let's talk about what we're going to learn about today. As the title of this webinar suggested, we're going to look at a few different topics that relate to the intersection of development and finance. I know we have a range of people on this call, executive directors, a number of folks who have a finance background or work in the finance role of their organization, board members, and development staff, and some artistic staff. So I'm hopeful that what we do, while some of it may be maybe information that some of you know, will be instructive for others, and that everybody comes away with an important piece of information, at least from this the four things that we're looking to achieve. First, that we'll look at the basic principles of gift accounting, make sure that we have some clear understanding for that as a baseline. Talk about that in the context of how development and finance can work effectively together. And look at some very specific and special cases related to gift accounting, and then end by talking about budgeting around the development budgets and some best practices to approach those with. So the impetus for this webinar was really about this idea that sometimes, and oftentimes I would even say, development and finance don't always see eye to eye. You know, I think there's a very typical scenario that I've seen where you go to a board meeting and the treasurer's report sounds a good bit different from the development chair's report when they're talking about the fundraising to date, and the numbers don't always look like they match up. And it's really from this understanding of how the gifts are counted for and how do we communicate that externally. Personally, for me, when I first came to Philharmonia, one of the very first things I did was step into the middle of an audit that was in progress. And one of the first things that I did in talking to our auditors when we sat down was going through some questions they had about gifts that had been made by donors that had restrictions placed on them, and were they properly released during that year. And we're going to talk about that in a little bit. But it very quickly prompted an opportunity for me to sit down with our development director here and for us to start looking through and trying to gain some common understanding about what had happened there. So I think it's pretty common circumstance, and dialogue is obviously a very important way to solve that. Kate, I'm sure you can offer an example as well about this experience of times when these two sides don't see eye to eye.
Yes, well, I've had a new client relationship where I came in as interim development director, and the finance director, before I even really started working, called me and had a 3-hour phone session to express frustration with how the former development director had not informed him when grants were coming in for a future year, and it threw off the development revenue report, et cetera, and it sort of went on for a while. So getting clarity around all of those issues is very critical. And you know, often you can have a couple of different ways of reporting internally, but you just have to be really clear what's counted for which purpose, and we'll get into that later.
Right. So fundamentally, one theme that will recur throughout this webinar is that it really comes down to two critical things to make sure this works and that both sides see eye to eye here. First is making sure that you clearly understand the donor intent for any gift that's provided. And second, that, and this may sound obvious, but that accuracy matters in how you report that, how you record that that gift and the intent behind it, and how you publicly speak about the gifts and communicate both through financial statements and through narrative reports about fundraising successes. So, you know, this, even though these two things may seem pretty clear, it's oftentimes where the misunderstandings can take place, or sometimes different perspectives can develop. The development director has had a long conversation, sat down for an hour or so, cultivating a major donor, securing a gift, and they have a lot of information in their head, not all of which trickles through to the finance side of it, and they get a gift and they may misaccurately code it or misunderstand what the purpose of it was. So when both of these things are in line organizationally, that both sides understand donor intent and that there's a really strong attention to accuracy, you can tell a consistent financial story, whether you're talking to your board, talking to external community partners, talking to donors, or talking to your auditors, you know, on the side of the finance folks. So we're going to start talking about some of the nitty-gritty now about what this looks like from the perspective of gift accounting. And it really comes down to this concept of restrictions. In gift accounting, or excuse me, nonprofit accounting, there are three what we call asset classes, and this is really important for anyone at a nonprofit to understand that touches the money in any way. So these classes speak to essentially a level of restriction that's placed on the funds that the organization receives, the revenue the organization receives, and they go from kind of the most constricted or from the least constricted in this case, the way that they're ordered, to the most constricted. So we're going to start by talking about them from the most restrictive perspective. the most restrictive of them is permanently restricted net assets. These are gifts that are usually, in almost in all cases, are gifts that are given for purposes of an endowment, adding to an endowment corpus. The concept behind these sorts of gifts is that the donor gives, say, a gift of $100,000 that it wants to contribute to your endowment. And they say, you know what, you can't ever actually spend that gift. I don't want you to spend the $100,000. I want you to invest it, and you can use the income that you earn from that to support, whatever. I mean, they may or may not provide restrictions on what the income can provide. But fundamentally, that means that the original gift has to remain intact and cannot be spent without going back to that donor and receiving permission from them to remove that restriction. So this is by far the most restrictive class of gifts that we receive. The second group, and this is the one that can be a little bit tricky, are what are described as temporarily restricted ones. And the description there of temporary, the temporaneity of this is really the key part of it, is understanding what makes it temporarily restricted. And there are two ways that you can have a restriction like this imposed. One that's a restriction based on time, or one that's a restriction based on purpose. So the concept of a time-based restriction, we have an institutional supporter, a foundation that gives us grants to help support our general operations at Philharmonia Baroque Orchestra, and oftentimes they'll make a multi-year commitment to us saying that, for the next 3 fiscal years we'll fund you at X level. We oftentimes will also receive the gift in advance of the start of the fiscal year. So for instance, we're right now in our fiscal year ending in June 30th, 2014 here at Philharmonia. And the money for this year's annual support came in before the fiscal year began. So we couldn't actually spend it then because that fiscal year hadn't begun and it was restricted to be used right now during this fiscal year. So it was put into this category of temporary restriction until we actually arrived at the fiscal year and started spending funds and could use the gift to help support that. The other type of restriction is one that we encounter quite frequently, and it's a purpose-based restriction. This is where the donor makes a gift where they say that they want it to be used for a very specific purpose. So it could be something like helping to support a guest artist that's coming to perform. Could be a little bit more general, saying that it's only to support the educational activities that your orchestra is doing. It could be to support an upcoming concert project. There are any number of types of restrictions. So the idea here is that once that commitment is made, whether if the funds are received in advance, they're going to stay in this restricted category until you actually have done the activity that satisfies the donor's restriction, at which point then it can become the third category, which is unrestricted. So we'll talk a little bit more about this in a few minutes, but when you've satisfied these restrictions under the temporary restriction, those funds become then unrestricted and become part of what we usually are used to looking at when we're looking at an organization's operating statement or operating budget. It's what we spend in a given year. So the unrestricted assets, though, are broader than that. Hopefully the majority of the funds that you receive in your organization are coming in as unrestricted gifts. And these are gifts for things like a gift to your annual fund is an unrestricted gift because the donor is not putting any specific focus on saying only spend it on education programs or only spend it on the supporting this great violinist that's coming in. And it gives you as an organization the greatest degree of flexibility to use those funds as well to spend it for whatever the organization's needs are that fit within the purpose of your mission and scope of your mission for the activities that you're doing in a specific fiscal year. When we think about the other revenue that comes into the organization beyond contributed income, things like ticket sales or CD sales or things like that, those also, when we look in a few minutes at the bookkeeping of this, those also fit into this unrestricted asset class because, again, they're just funds that are coming in that are being used for general operating support during the course of the year. So I'm going to move on and talk here now. Or actually, sorry, stop talking here now and give you a chance to see how well I was able to explain those. This goes back to my teaching days. I always love to throw in some checkpoints here and do a quick quiz. There are 7 different scenarios here. I want you to just take a minute and grab a piece of scratch paper and a pen or a pencil and identify which of those 3 categories, unrestricted, temp restricted, or perm restricted, each of these gifts are. So we'll pause for a couple of moments of silence here.
It's Chris. I'm uncomfortable with silence, Michael. Are there
I
prizes
knew you
for
would be.
getting the ball
This is the problem where everyone's muted, but
Right, exactly.
yeah, people
this is
write
the-
their results in.
Okay.
Well, let's go ahead and go through them here. So the first one, the annual fund contribution given with the subscription renewal campaign. That one is pretty straightforward. But Chris and Kate, you're on the phone, so why don't you guys chime in and tell me what you think?
So the annual
just muted
fund
myself.
contributions are always counted in the year in which it is received. So even
Right.
though it's associated with the subscription renewal for the following season, it gets counted in the current year.
That's right.
Is that clear to everyone? Any questions that we should address around that? Okay.
Good. So it's an unrestricted gift. It didn't have any specific constraints put on it, as Kate mentioned, that even though it came in with a campaign, a subscription renewal campaign that counts for the next season, the annual fund component of it just is counted when the cash is received. The second one, a contribution to bring in a guest artist. So here we have a restriction that's being placed on it. It's being focused specifically around supporting this guest artist coming in. So that's a case in which that gift would be a temporarily restricted gift that couldn't be released from restriction until that artist has been engaged, performed, and paid. The third one is what we started off in talking about these restrictions, gifts to the endowment. So here again, you have something that's permanently restricted and is not you're not allowed to actually spend that gift itself. Only the income you can generate through investment. Fourth one, gift to support a fundraiser for which that person cannot attend. Generally, unless there's any specificity put on this, it's going to be unrestricted. Most of the fundraisers that we operate over the course of a season are aimed to raise unrestricted funds, or ideally are. If you, though, are putting together the fundraiser explicitly to support the education programs, again for the orchestra, then there is a restriction that the money that's raised through that fundraiser gets placed on it by nature of the fact of how you've promoted it and what you've asked folks to contribute towards. Number 5, ticket sales for a concert. These are going to fit into the unrestricted bucket. 6, corporate support of a 30th anniversary concert that's coming up in 2 years. This is a temporary restriction, and it's a time-based restriction in this case, as well as a purpose-based restriction, because you have something that's coming up in a future period, and it's to support a very specific concert that hasn't yet taken place and for which you have not yet spent the funds. Then finally, when you get a windfall bequest that the board puts into a cash reserve. So the board has made a decision in this case that they want to take this windfall bequest and develop a cash reserve for the organization. So the board, in a sense, has kind of segregated that money, but that's not a restriction that's placed on the funds other than what the board has, or excuse me, the restriction didn't come from the donor itself. The board is deciding how they want to treat it, and the board can certainly do that, but it doesn't create a restriction on the gift other than that which the board, through its own internal policies, has created. So it would be considered an unrestricted gift that comes in during that period. All right, so let's talk about some of the special cases that have to do with gift accounting, because we can get into more complicated waters when we start talking about things like endowments. So endowments, the key thing to realize here is that there are really 2 types of assets that go into endowments. Most commonly, you're getting donor-restricted assets where the donor makes the contribution and says, I want this to be part of the permanent endowment for this orchestra, and therefore it becomes permanently restricted, so it goes into that red bucket. But not all of the funds in an endowment are necessarily going to be that way. The board can add additional funds or commingle some funds that will be put into the endowment investments that itself has segregated off. So for instance, let's say in the last fiscal year, the orchestra ended up with a $30,000 cash surplus that the board has decided, well, we'd like to put that $30,000 into to our endowment so that we grow the size of our investment portfolio there and hopefully add additional funds for the organization. The board, again, has made that designation, but was not made by the donors themselves when it was initially given. So in that circumstance, then, the funds, even though they're sitting with the endowment investments, are unrestricted. So if we think about this, the question becomes, what can you spend? When you're dealing with an endowment where you have a base that has $1 million that came in from donors and then $250,000 has been added in by the board, you can spend from that $1 million base. You can't spend any of the original $1 million that the donors gave you. You can spend the income that it's generated through the investments through the returns on those investments. You can, if the board chooses to do so, the board could spend all of the $250,000 that comprises the board-designated endowment, because again, those are unrestricted funds that are just sitting for investment purposes that are mingled in with the investments from that.
Michael, may I just interject?
Please.
Because there might be a little confusion. Unrestricted is, I believe, commonly thought of as annual support, but in this case, it's part of the endowment. So that needs to be clarified internally when you do move something from your annual budget to the endowment, in the case of a surplus, for example.
Right? Exactly. Okay. That's exactly right. Right. So when you get to the point at the end of the fiscal year, if you're going through an audit and there's a component of your endowment that has unrestricted funds, we'll look in a minute at the financial statements that organizations regularly produce. But what you'll end up finding there is that a component of your endowment is being reported in the unrestricted assets category because it has this board-designated component.
And typically those decisions are not made until the end of a fiscal year.
Correct. Yeah. So the board, in this case, it may be based on some sort of policy that the board has. For instance, that windfall gifts through a state bequest that come in unsolicited or that were unanticipated automatically are placed into the endowment, whether or not there's the donor originally intended to be so. So sometimes there are organizational policies that are set that way. But otherwise, right, that it may be done at the end of the year.
So very important for the Finance Committee or whichever committee of the board is responsible for setting those gift acceptance policies to be clear if there's a level, for example, for unrestricted requests to go into the endowment.
Exactly. So another part of the gift accounting that can sometimes create confusion particularly between development and finance is when money isn't showing up that the development department has raised in support of, say, an upcoming project, and they're looking to see it when they're looking at the treasurer's report or the organization's operating income statement, but it doesn't look like it's showing up there. And there's a couple of key principles here that need to be understood from an accounting standpoint. First one is this idea of the matching principle. And the matching principle is based on this concept that you want to show the expenses and revenue at the time in which both of those are, in the case of expenses, the expenses are incurred and that the revenue is earned. And that you want to match them up in the same fiscal year. So if the development department has done a great job and you have a 30th anniversary concert coming up next season, the development department has approached a major donor and said, this is going to be a big special event. It's going to be more expensive than other concerts because we're bringing in this artist and doing this large program. And they've secured a $25,000 gift of support from one of your key supporters. That's great. But it's not going to show up until the fiscal year. It won't show up, I should say, in your operating activities until the fiscal year in which you actually do that concert and incur the expenses to support it. And this is also a reflection of these two different, what we call bases of accounting. Most organizations are operating from the accrual basis of accounting, but when you're in a very small organization, you start off with what's the simpler of these two concepts in a cash basis accounting. So the idea of cash basis accounting is that whenever cash comes in or goes out, whenever you receive it or you spend it, that's when you show it on your financial statements. And as you get to be larger in an organization and more sophisticated, where you're doing things like securing multi-year gifts or raising funds in advance of an upcoming project, it becomes more complicated to treat it that way. So Under accrual-based accounting, which is what many of our organizations, and I would guess probably all of the organizations of the individuals on this call use, revenue is reported when it's earned, expenses are recorded when they're incurred. So it's very much similar to this concept of the matching principle that you'll see in your financial operating statements, the revenue and the expense when they're actually being either spent or earned. So you have things that are cases where this doesn't always follow, or it doesn't always appear quite so simply. Something like subscription income is an obvious one for us. Many of us start our subscription campaigns in a fiscal year the fiscal year prior to the season in which we're going to be actually performing these things. So for Philharmonia, in March we start receiving funds that are going to help us support the concerts that will begin to the following October. So we have all this money that's been brought in and is there for us, but it's not going to show up in our current year operations because it doesn't have to do with the concerts for that season. A similar thing happens when you receive a pledge, in advance of something that, in advance of the time that you're doing a concert. So what we described before about that 30th anniversary concert, that someone's made a commitment, possibly even made a payment towards their commitment to help support this 30th anniversary concert before the fiscal year actually begins. So the key concept here is that revenue will be recognized when it actually comes in from a financial standpoint. Of course, you're going to acknowledge the donor's gift at the time the commitment is made and at the time that the gift is received, and that's different from the organization's reporting purposes. So the question ends up then being, well, where is the money? If we receive the subscription income, if we receive this gift from a donor in advance of the actual event, where does it show up? And here we want to take a look at the two financial statements that are commonly used for organizations in reporting their fiscal health and where they are. The first one is the statement of activities, is also referred to as the income statement. The second one, the statement of position, is referred to as a balance sheet. I'm going to switch out of this presentation now and pull these up, and I believe hopefully all of you received in advance of this these two documents to take a look at so that we could follow along. Is the font large enough, Kate and Chris? Can you guys see this okay?
I'm actually in a different screen. I need to switch something.
Okay. Well, I'm going to assume that everybody's doing okay with this.
I can see it. I can see it nicely, Michael.
Great.
It's good on my screen. Yeah.
Good. So the first statement, and this is one that probably many of you have seen, though maybe not quite with this with the columns as they're organized here. This is what's called the statement of activities, or sometimes just simply the income statement, or even sometimes in a for-profit setting, the profit and loss statement. The way this document is organized is you're looking at the revenue here in the first segment here, and we divide it up between our earned revenue and our contributed revenue. Earned revenue being things like our subscription single ticket sales, and contributed revenue being things like contributions from individuals, board members, foundations. And then the second component are the expenses that we incur and the net difference between those two. So going across the top here, the columns that you can see I'm presenting are the three different asset classes that we've been talking about throughout this. This is what you're going to see in any of your audits when those are finally reported out and during your auditing process. Because for a nonprofit organization, as we mentioned at the top of this, we have to track what's happening in these three different asset classes. However, when you're at a board meeting, for instance, and looking at the current financial statement, often what you're seeing is really just this first column of what's happening in the current year in the unrestricted category, the operations category. And you might have columns that show here's what we budgeted, here's where we are to date, here's where we expect to end the year. Those might be the columns that you're using, but you're looking at it from the perspective of what's happening during this current fiscal year in terms of our operations. So from this perspective, though, looking at it with the three different categories, we can see a broader picture of what's happening and where the money is going. Look at the board line, line number 8 here. You can see I've highlighted down some numbers that are put into temporary and permanent restricted, the permanently restricted columns. So what this is indicating is that in this fiscal year, June 30, at June 30, 2013, the fundraising aspect of the organization brought in $100,000 in support from the board to help support unrestricted operating activities. In addition, there's a gift of $10,000 that was secured that's gone into temporary restriction. On some subsidiary schedule, there's a note about what that gift is, what the restriction is that's placed on it, and what's going to be required to release that gift. Also, the development staff did a great job because they brought an additional $5,000 to the endowment, which is this $5,000 permanently restricted column gift here. So if you're only getting a chance to see the first column in most of the financial reports that are happening during the course of a year, the development department might rightly say, hey, wait a second, I brought in another $10,000 to support this upcoming concert, and I brought in $5,000 to the endowment, but that's not showing up there. Well, this is the reason, because when we're talking about the operations, we're only looking at what's happening within the context of that fiscal year. We're not looking at things that are for a future year or future purpose, and we're not looking at things that are fitting into the permanently restricted assets, what's happening with the endowment. I'll show you in a minute where those do show up in the financial statements.
So,
the other
Michael,
thing,
may I interject here
please.
just to talk about the contributed revenue reports? What I've often done is to show temporarily or permanently restricted gifts either above the operating report or below, so that they are reflected in what development has achieved, but it's not confusing, or hopefully not confusing. And we also explain it in the narrative that accompanies the contributions report of what was raised in support of operating versus anything else, special projects, endowment, future years, and so forth.
Great. Yeah, and so there are different ways to present this information. Again, this is the financial statement presentation, but it's important that you have a way of presenting it so that the story can be told. The other line I want to point out here is this release from restriction line, line 11, and this is really this idea of how do funds go from being temporarily restricted and into unrestricted operations once you've met the restricted purpose for which they were provided. So here what's happening is that over the course of the season, $35,000 that was committed at some point for whether it's a very specific project or something that had to do with the funds during this year, we satisfied those restrictions. So you can see the parentheses here mean that we've decreased the temporary restricted assets by $35,000 and increased unrestricted assets by $35,000. So those funds now show up in our operations for the 2012-13 year. At the very bottom here, when you look at, so what's the bottom line with what's happened with the net assets, this organization ended its year with a $5,000 surplus for its operations. Good job. It's ended up with a $15,000 deficit for its temporary restricted assets. And all that means is that over the course of this year, you brought in $10,000 for a future project, but you released or satisfied the restriction on a greater amount there. So it's not a negative thing. It's simply when were those restrictions satisfied, and when are they being moved out of there. And then again, the $5,000 that was raised for the endowment. So the other statement is the statement of financial position. And this is also described as a balance sheet quite often. Here, this is showing a snapshot in time rather than the prior statement, which was looking at it over the course of the current fiscal year. What are the activities that we're doing, and what's the income that we're generating from them, and the expenses that we're having to put out. Here, the statement of financial position is about giving you a snapshot in time. If this organization ceased operations today, what would our financial position look like? And it's broken up into three categories. This first category is assets, which are things that the organization has of value, whether it's things like cash, which are very clear, commitments to give, which are described as receivables, funds that are in investments, or things like property and equipment that you've bought that has value and retains some value over time. The second category here are liabilities. So these are things that the organization has an obligation to others for, typically owing. Accounts payable, things, the invoices that you have outstanding to vendors. If the organization has any loans or debt. And then this deferred revenue is where subscription income shows up. So at June 30th of this year, this organization received $300,000 in subscription orders for its next season's operations. If for some reason we discontinued operations on June 30th of 2013, we'd owe that money back to those people because we haven't actually provided the concerts for which they gave the money. So in that case, it's a liability. And then the third group of information here are the net assets, which go back to those 3 net asset classes that we looked at before. So this essentially says when you take the assets, remove the liabilities, what are you left with? Here are the assets that this organization holds. And in June 30th, 2013, the organization had an accumulated unrestricted net assets of $20,000, which was in part because we ran a $5,000 surplus this past fiscal year and likely had some other healthy years in the past. Our total account for temporary restricted assets now is sitting at $35,000. So that means these are commitments that have been made or funds that we've received for future projects that have yet to be actually expensed or that we've yet actually satisfied the purpose for. And then that we have a permanently restricted set of assets, and these again are going to be the basis for our endowment investments of $670,000. So the funds that are raised by the development department for the endowments are showing up here on this balance sheet, or if they're for a future project that has to be have the restriction met, they're showing up in temp restriction right now. And the way these financial statements are made, they don't necessarily show that story very clearly, but they are there and they're being accounted for. So let me go back here into the presentation. Last thing that I want to talk about before Kate speaks on some other topics is about when you can record a gift. Because this, again, is another point where sometimes you have a disagreement between finance and development. When a gift comes in, a cash gift, whether it's by check or by credit card or as a true cash payment, you can record it at the time that it's received, just making sure that it's properly coded and reflects whatever the donor's intentions are. If it has a restriction on it, put it in temporary restriction. If it's not, that it goes into the unrestricted funds. When you come to something like pledges, though, it gets a little bit more complicated. And the key thing here is that pledges and documentation is what's going to make your finance people happy. So when I've had conversations with donors about upcoming projects that we're interested in asking for their support, typically we'll begin the conversation and we'll hopefully come to some resolution through 1 or 2 conversations. But until I actually have something documented in writing, I really can't, in our finance department, we rightly say we can't mark this down as a commitment to give that the organization can rely on. Once I have some sort of trail of documentation that shows whether it's an email confirmation where the donor says, yes, I plan to give whatever, or a signed pledge letter, then we can actually mark that down in our accounting software, show it as a receivable that we expect to receive it, an intent for the donor to pay, and start crediting that commitment of support in the organization's asset. What's tricky when you're dealing with pledges is when you look at multi-year pledges. And here again, you have to make sure you understand the nature of the multi-year pledge and are very clear about what the donor is intending to do. I spoke earlier about one of the institutional funders or foundations that we have that supports us, and they'll often make a multi-year pledge to support our annual operations, and they'll do it, say, $25,000 a year for the next 3 years. So there, they've made a cumulative pledge of $75,000. But when we treat it from an accounting standpoint, we need to treat it as a pledge to give $25,000 in this fiscal year, pledge to give $25,000 in support of the next fiscal year, and a $25,000 pledge to support the following fiscal year. That's different than, say, someone who's going to make a pledge. Theoretically, a donor could say, I'm going to pledge $10,000 in support of your annual fund for this year, or I want to support the concert that you're doing this year and I'm going to give you $10,000, but I'm going to have to pay part of it during this fiscal year and part of it during the next fiscal year. Well, in that case, the treatment is different. You have a commitment that's made where the funds are intended for something that's happening in your current fiscal year, and therefore the revenue from that pledge should be recognized in this fiscal year. All $10,000 should be recognized, even though the donor has already told you that their payment plan will take a couple of years to come through. So there are different circumstances, and that's why understanding very clearly what the intention of the donor's pledge is, and understanding things like payment schedule and timing on the payments is really important to clarify. So when you're thinking about making sure that you get this right in the office operations, when these gifts are coming in either through commitments to the development staff or coming in the mail through some sort of campaign that you've done, making sure that you have clear and organized policies and procedures for who's going to receive the gift, and that you can accurately identify the gift at the time it's received, to make note of things like restrictions that are placed by the donor, if it's being paid in installments, that it can be tracked that way, that it's going to be coded properly in your accounting software. And one way to get there is by providing some sort of cover sheet that helps the finance department understand that there's a donor intent for this gift and that it has some restrictions placed on it. I'll show you just a very quick example. This is something that we created here at Philharmonia, where we track down and we attach this to the gift that comes in and put it on top of it. And this is really to help us track these more complicated gifts. So marking the donor name, when the gift was received, and who it was received by. Then these opportunities to check off, was it an endowment contribution? If so, were there special restrictions or instructions with it? Was it a restricted contribution coming in from individual, corporation, foundation, or government? When do we expect that we're going to satisfy that restriction? And what are the specific restrictions that were placed on it? When you have clear documentation like this, it makes it much easier for both the development department and the finance department to be aligned in what they're doing.
And you can actually modify this form for your annual gifts, for those that come in over the phone, by credit card, or don't have other written documentation, to make sure that development and finance have a record of what the purpose and the timing of the gift was. So if it's for your gala versus your annual fund, got the check, or if it's a contribution for the gala rather than a ticket for the gala, again, you want to be very clear.
Right. So Kate, I'm going to turn it over to you now and let you.
And part of the getting it right and tracking the gifts correctly is regular reconciliation between finance and development. So I would say that it should be done at least once a month, if not once every couple of weeks. And you'll decide for your own organization and how many gifts, how busy you are, but to make sure that you have a process for ensuring that the finance department has the same information that the development department does. Because sometimes you may have separate databases. If you're not connected, there may be duplicate entry, which is not always helpful, but sometimes can't be avoided. So again, I'm sure you have procedures in place, but if not, you should make some procedures. Who opens the mail? Who inputs the gift into the finance database, if it's different from the development database, who deposits the money, and then who from development and finance meet to review the records on a regular basis.
Kate?
Yes.
It's Chris. It occurs to me that in looking at our registration list, we have some people on the call that are with organizations that do not have a finance department, do not have a development department. And I wonder if they've even got gift acceptance policies or any accountability documents in place. And I'm wondering if after the call, if they're unclear about having, because it's important to have these, if we might be able to provide something for them.
Sure. And I would say in that case, if it's a one-person shop, and Michael will chime in here, you may want to have a check and balance with the board treasurer, for example, because more than one set of eyes should be involved with the money. at least
Right. That
periodically.
makes a lot of sense. Exactly. Yeah. And we're happy offline to deal with some more specific questions if you are in a small organization and how you can help do that.
And there is a resource, I don't know if Michael, if it's up on the screen yet, the Council for Nonprofits has sample gift acceptance policies that you can look at and adapt to your organization. Michael, are you still controlling the main slides? Yeah, there we go. Okay. So, yeah, and so you want to make sure, obviously, that gifts are acknowledged in a timely basis and that they're not sort of sitting unopened, and that action is taken when gifts come in, and that they're placed in the right buckets. Again, for smaller organizations, it may only be, you may not be dealing with endowments or other kinds of restrictions, but you want to just be clear and clear with the donors what you're thanking them for and how you're reporting how the gifts are used. Let's see. Sorry, I'm on a different screen here. I have not been able to see any questions come in. I just want to do a check to make sure that everyone is fine. So if you have a question, I saw one come in that seemed that Michael's voice wasn't clear. I hope that's been rectified. Okay, so again, reviewing gifts when they come in, how they're entered, making sure that you're not confusing ticket sales with contributions. I've had that occur in some organizations. You don't want to thank a donor for a contribution if it's a ticket sale because it's not tax deductible. You also want to make sure that you have language in your acknowledgement letters or receipts that explains how the tax deductibility works, or that has a line saying that the gift is tax deductible to the extent allowed by law if you're not exchanging any goods or services. If you are exchanging goods or services, you need to make sure that it's stated. If it's for a gala ticket, you have to assign a value to what is received. So I'm sorry, I'm seeing now on the questions that still unclear about multi-year pledges and how to process and record them. Michael, do you want to talk about how you handle that? Okay, I'm now.
Sure, I'm happy to talk about that. With a multi-year pledge, what you would do, the key thing here is whenever you have a pledge of commitment from a donor, whether it's for a single year or a multi-year, and if you have it in writing, it's something that you can then add to put down in your accounting tools in your books as a commitment from them to pay. So it becomes a receivable from that donor. What I was referring to before is that for multi-year pledges, the key thing is understanding what the donor's intention is for how that pledge is to be used. If it's a pledge that's meant to be, they're making a multi-year pledge, say that this is a board member and they're committing to make a gift to the annual fund for the next 3 years, you would make this, the way I would put it into my accounting software is it's a pledge of, say, $10,000 a year over 3 years. I would put it down as 3 separate pledges of $10,000 for each of those years, and so that it's clear which one's going to apply to which fiscal year in the software, or excuse me, in your record keeping. If it's a pledge that's going to be paid over time in multiple years, but applies only to a very specific fiscal year activity, whether it's a concert or or just the general operations for that fiscal year, then you should record it down as a single gift, say $30,000 for that gift in the fiscal year that it's going to be used. And then be sure to make a note in there of the payment schedule for this so you can anticipate when the payments on this receivable will come.
So I think there's still a little bit of unclarity. The $30,000, let's say it's $10,000 a year for 3 years. The $30,000 gets, if you have the pledge in writing, the $30,000 gets booked as a receivable for the, on the financial side.
Right.
So that's how it's recorded there. But when you thank the donor, you need to be very clear. The donor is thanked for his pledge of $30,000, for years 2014, 15, and 16, of which $10,000 is a gift in 2014. So then you would write to the donor every year when the check comes in, thank you for your payment of, your second installment of $10,000 in fulfillment of your $30,000 pledge, because the donor is going to take the tax deduction in each year. The donor cannot take the $30,000 deduction all in the first year.
Right.
So you want to be really clear on both sides of the table.
Yeah, and to make sure that, because Lee's point is that when you get a pledge, a commitment of support, you record the entire pledge when it's made. That's always correct. Now, what the question is, where does it get recorded? In the case where it's going to be in commitment or in support of something that's a future project, you're going to be putting it into temporary restriction. It's not going to show up in your unrestricted assets for that present fiscal year when the pledge was made. But if it was made for something having to do with the present fiscal year, then you'd book it all in the current fiscal year as well. So where it ends up being booked is depends very much on the donor's intent.
Michael, also, what I'd say also is that a lot of this is language specific. Booked, a receivable, balance sheet. I think you've already talked about this, but these gifts can show up on your balance sheet, but they're not in your income for that year. And that might be some of the confusion that he's having.
Correct. Okay,
right, exactly,
so,
yeah.
Moving to budgeting, how do you figure out how much money will be raised in a given year? That's where this tug of war often gets very, very sticky.
Actually, Kate,
because
this is
often
Garrett.
it seems.
Yeah, this is Garrett, the executive assistant. It turns out that Don Kindred from Corona has his hand raised. I think he would like to ask a question before we move on. So if you can go to his list and you can unmute him, and then he can speak if you would like. Michael, you might be able to do that as well. Don, can you hear us? Can you speak?
There we go. Don, you should be unmuted now. No, maybe not.
Oh, Don.
It was for a second.
Don, can you hear us?
Yes, are you, can you hear me now?
Yes, we can.
Yes.
Go ahead.
Okay, great, thank you. I've got some donors that are giving on a monthly basis through a PayPal account we have, where it's X amount every month. On an annual balance sheet, would I put a total amount on the balance sheet of what they're going to give in a year, or do I just report that as it comes in every month?
Don, the best practice with that is to report it as it comes in, because if the donor at some point decides to stop midway through the year for whatever reason, you wouldn't want to end up having to remove the remaining part of what would be considered a pledge, unless they've explicitly made a pledge that says, I'm going to pay you, $100 a month for 12 months. I would just do each one as they come in.
Okay, and then also on restricted funds, where let's say you have an endowment amount and we're obviously not spending that, but if we invest that, does the interest and dividends off that investment go into unrestricted funds?
That's a complicated, well, it's the way that the endowment regulations or policies work is that those funds are officially sitting in temporary restriction until they're actually allocated for use. So if once you decide, the organization decides to spend them, they do show up as unrestricted funds, but until that happens, they're considered temporary, they're restricted funds. This is just one of the arcane aspects of endowment accounting.
Okay, thank you.
Okay, so we have a few minutes left, so I'll try to move through this quickly, but I want to talk about the projections again in budgeting. It's very, very important for development and finance to have a conversation before the budget is set. So before development is simply assigned a number, this is what you have to raise, it's good to have a conversation. And what I've often done is make a detailed sheet of the annual fund donors, especially, let's say, all donors of $1,000 and up. So how many did we have last year? How many are we projecting that we'll have this year based on past practice, based on we're looking at acquiring X percent new donors at giving at various levels. And you look at your history in developing the next year's budget. Here's what I think we'll be able to raise based on what we did last year. So I do it in the individual category, in the grants category, every contributed revenue category that you have, how much we think this gala can raise, so that you have a clear understanding of what you believe, what the development department believes is achievable. And that's where the tug of war is. Well, the operations side, we've got a contract that we've got to satisfy. We've got to do this repertoire. So careful planning of, when you make those decisions is really important. And it's important, I think, to have everyone on the same page. And then it's very important to adapt and adjust as you can throughout the year, at least keeping track, as Michael mentioned earlier, with your columns, if you have a financial report that you do monthly, looking at what was budgeted in various categories. In development, I do this, how much I think we're going to raise, and often it becomes a cash flow issue. So how much do we think we're going to raise by December? And then how much do we think is going to come in the second half of the fiscal year, or by quarter? However you want to do it, we know that X Foundation always pays their grant in March. So we know that March is going to be a good month, for example. So you want to make your assumptions based on past practice, where your growth areas are realistic, that you believe are realistic. You will always have some donor attrition. So you want to really develop a rationale for creating the contributed revenue budget. Just as you do for ticket sales. What is the past history? What kind of programming are we doing where we think we're going to sell more tickets? For development, you might want to talk to your program people. What are the new education initiatives that could be really exciting to certain donors, individuals or institutional donors? So setting these budgets is very important, and you really need to have a rationale for each number, I believe, rather than just the plug that you see, I think, on the screen. Any questions in that area? So big fish versus little fish. Depending on the size of your budget, the donor base, and your staff resources, you need to determine who you can track individually versus the larger groups in terms of the donor assumptions. You also need to assume that something special is going to come up every year that will require extra funds. And this often happens that the music director has a special project that comes up that he really wants to do in the season, and it's not necessarily part of the strategic plan, but the board decides, well, we got to keep the music director happy, and so we're going to do this anyway. And so they look to development. Well, we need to raise $20,000 so that we can do this special. So I'm being a little bit glib and flip about it, but I have experienced that these kinds of things come up, and it's, again, good to get everybody in the same room. It's best if you can do that before the decision is made, and that is obviously an advantage of having a strategic plan. You can point to the plan that says, well, we really want to do that, but we haven't planned to do something like that for another 2 years, so let's wait. But opportunities come up, and sometimes opportunities come up because a donor has a very generous offer, and it's going to really move the organization forward artistically. That's the good case scenario. But you do want to be able to make these forecasts and do reprojections on a regular basis so that you don't come to your board on May 15th when the end of the fiscal year is June 30th and say, oops, we're off by X thousands of dollars and we're not going to be able to make up these funds by the end of the year. So again, you get new information from a funder that's making a new gift, or they're postponing giving you that grant. The major fundraising event did much better or much worse than expected. You've lost several key donors. You want to stay on track of all of these kinds of events to be able to, where you can adjust if you have to try to cut expenses, or you understand that you're going to have a deficit and you look at, funding that somehow, thinking about a campaign down the road. So you just, again, want to be as accurate as you can in projecting where you're going to end up. And so I like to do it on a monthly basis, even if board meetings don't happen every month. I think it's really important that, again, development and finance talk regularly, and that you go through the exercise of looking at the numbers in every category to make sure that you're on track, and if you're not, that you know why. So that's where we're trying to get this tug of war between development and finance to a new place that will make everybody much happier and the organization more successful and clear in its accomplishments. So
That's not a picture of Michael and Kate hugging, by the way.
No. So I would just maybe make one more call for questions. I'm sorry that we had to speed up here at the end, but again, it will be available to everyone, and we're available to answer questions offline as well.
Yeah, we have a question from Diane Salisbury asking about, or noting that they're trying to come up with a clear format to report endowment income to their board members. They're using they're in the midst of their first endowment campaign and are splitting their funds between two foundations. Diane, I think there's a few different ways that you guys could approach doing that, and part of it depends on whether you want to fold it into your existing statements that you're using, your existing financial statements, or if you want to give a separate report for the endowment specifically. But it might be good to talk about that one-on-one, and I'm happy to do that with you.
And then there was a question about real estate, I think was answered. Okay.
Right.
Anything else? Well, thank you for joining us, and I hope all of your seasons are going well, and you're raising lots of money and selling lots of tickets, and we'll look forward to seeing many of you at the conference. Chris, do you have those dates?
Yes, I do. They are July 31st through August 2nd. Will be in Sonoma County, and more fabulous sessions about finances if you need to have them. And I'd just like to say thank you so much to Kate and Michael for giving your time today to AXO and to our members. This is really great. I hope it was helpful to all of you. And as Kate said, be in touch with me or be in touch with Kate or Michael directly if you have other tough questions or questions that might take longer answers. Thanks again, Michael and Kate.
Thank you.
All right, take care. Bye-bye, everyone.
Bye-bye.